Coca-Cola and Hershey's are great companies that have been around for decades. They also make excellent investments for those investors looking for less risk, more stable growth, and less exposure to macroeconomic factors like unemployment and GDP growth. But which one of these two dividend stocks is better, Hershey's or Coca-Cola? I'll answer that question in this video, comparing the two on revenue, operating profit margin, and cash flow from operations. And then I'll look at their valuations. I've done discounted cash flow valuation models for Hershey's and Coca-Cola. I'll share those with you in this video. I'll also compare the two on their forward price to earnings ratios to ultimately come to the decision on which one of these two is the better dividend stock to buy. So let's get started. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Looking back a decade at their trailing 12-month revenue, Coca-Cola demonstrates an interesting pattern where their revenue was falling until 2021, and then they demonstrated growth again. Now, Coca-Cola has made several acquisitions and divestitures in this time. They're frequently selling off business units, selling off their orange juice unit, buying a milk unit, etc. So their revenue numbers in aggregate don't tell the real story about the company's growth. And the company's growth has come primarily from price increases, especially in the last 3 years since the onset of the pandemic and then the economic reopening. Coca-Cola has been able to exercise premium pricing power and increase their prices and still retain their customers. They haven't experienced a big exodus of customers because of those price increases. Coca-Cola is more exposed to macroeconomic factors than Hershey's, although each of these two are not very much exposed. They are habitual products, not very much products that are discretionary. Like, for instance, if you get a job, then you might go to Macy's to buy a new suit, right? That's very dependent on macroeconomic growth, employment growth to be precise. Coca-Cola is somewhat exposed to those kinds of factors because they have a large market share in away from home channels like McDonald's and movie theaters, etc. So when you are making more money, you're going out more often and you're consuming Coca-Cola's beverages in those areas more often. If you're not, you're staying home more and still you're experiencing Coca-Cola's products, but maybe a little bit less so than if you're going away from home. Hershey's, on the other hand, doesn't have all that much exposure to economic factors. I would say it hardly depends on macroeconomic factors at all, right? If you get a job, if you get an increase or a promotion, are you any more likely to consume any of Hershey's chocolate as a result of getting a job? Probably not. And if you lose your job, are you any less likely to consume Hershey's products? Probably not. They're not so expensive where you look at that as a category to pull back. And so it doesn't have that kind of economic exposure, which is good for investors because it insulates you from those macroeconomic factors, which you are probably exposed to in other areas of your portfolio. And if not other areas of your portfolio, maybe in your career, maybe you have a house and your home price value is exposed to macroeconomic factors. And so owning one of these two stocks could be a nice hedge against macroeconomic growth or macroeconomic recessions worldwide or in the United States specifically. Now, looking at their ability to generate profit margins, you see excellent execution here from Coca-Cola and Hershey's. The operating profit margin for Coca-Cola over a trailing 12-month period has soared to 29.5%, up from 22% in 2015. Similarly, Hershey's operating margin has soared to 26%, up from 18% in 2015. This is a demonstration that the companies have learned how to serve their customers better. Every year that they operate, they learn how to distribute their products better, manufacture their products better, market their products better, etc., etc. And so you see their operating margins improve over time, which is what you want to see, which is what you want to see. If you don't see improvement, then question marks should arise. How are you not improving? You've been in business for decades and your operating margins are not improving. That should raise a red flag. Is that a strategic choice? Some companies, that is a strategic choice, and so that's okay. Other companies, that's not a strategic choice. It's a matter of being unable to grow their margins. And so in this case, they both demonstrate excellent growth in their margins and excellent improvement at the level of their operating margin as well. And we see a similar story in terms of cash flow from operations to sales for Hershey's, although Coca-Cola has experienced some negatives, some declines in their cash flows from operations. Coca-Cola's cash flow from operations has fallen to 14.5%, down from a peak of 35%. Meanwhile, Hershey's cash flow from operations is up over 21%. That's up from around 14% in 2015. Coca-Cola's cash flow from operations over the last couple of years has been volatile because of several one-off factors, and I wouldn't be surprised after these factors are lapped if their cash flow from operations returns to levels above 20% over the next few years. Now that we've looked at the companies and their financial performance, now let's look at the valuation. And let's start with Hershey's and my discounted cash flow for Hershey's. I calculated an intrinsic value per share for Hershey stock at $262. That compares favorably to the current market price of $158. Now, I mentioned that Hershey's is a lower risk business, and that's reflected in the company's beta. It has a beta of only 0.37, and that measures very low risk for a business. So I looked at several scenarios where I increased Hershey's beta to look at what the intrinsic value would be. And if I raise the beta to 0.75, the intrinsic value per share would be $162. Any beta above that, the intrinsic value per share would be below the current market price. But I don't believe that Hershey's stock should trade at a beta that's much higher than where it is today because of the factors I mentioned earlier, its lack of exposure, its lack of correlation to macroeconomic growth factors. Similarly, I calculated an intrinsic value per share for Coca-Cola, and I found it to be worth $102 a share. That also compares favorably to the current market price of $69 a share. Coca-Cola's beta is also low, not as low as Hershey's at 0.62. And I agree with this, right? Remember in the beginning of the video, I talked about how Coca-Cola has a little bit more exposure to the macroeconomic factors compared to Hershey's, and that's reflected in the higher beta. I also looked at a scenario where I raised Coca-Cola's beta to 1 and the stock price, the intrinsic value per share would be $65. But again, I don't think Coca-Cola should trade at a beta of 1 given its lack of correlation to macroeconomic factors. Maybe the highest I think it should go would be 0.85 or zero point 0.8 as beta. So when I look at their valuations on a forward price to earnings ratio, they're similar here. The Hershey's company trading at a forward PE of 23, Coca-Cola trading at a forward price to earnings of 21.5. So both excellent businesses. I have them both rated as a buy, but if I had to pick just one of these two businesses, I would pick Hershey's because of the better valuation on the discounted cash flow model and the better operating margin improvement and cash flow from operations improvement and the lower riskiness compared to Coca-Cola. It's meaningfully less risky than Coca-Cola, although they're both very low risk businesses overall. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.